Have you ever stopped to think about the real financial life behind the things you see every day? Not just the coffee machine in the office break room, but the whole building you're in, or those huge like humming machines in a factory. It's actually not just about what a company pays for them initially. There's this hidden kind of complex journey, valuation, use, eventually retirement on the company's books. So today we're doing a deep dive into this, well, surprisingly fascinating world of accounting for property, plant, and equipment. PPE, as accountants tend to call it. We're using material based on International Financial Accounting Standards, IAS 16 specifically, to really unpack the critical rules and honestly some surprising insights about how these big tangible assets shape a company's financial story.
Yeah, and our mission today really is to cut through some of that jargon, give you those aha moments. We want to show you why understanding how companies account for these core assets, their most tangible investments, is so crucial if you want to be truly well-informed. We'll follow an asset's whole life, right from the first dollar spent through its working life, how its value changes, maybe goes up or down, right until it's finally off the books.
Okay, let's unpack that first bit then. The acquisition. The start of its life. So when a company buys something big, a new machine, maybe a fleet of trucks, or they build a whole new store, how do accountants figure out what actually counts as part of that initial cost? It can't just be the price on the invoice, right?
No, you're exactly right. It's definitely more nuanced than just the sticker price. The main idea, the principle, is that a company has to capitalize, which just means add to the asset's value on the balance sheet all the costs they incur to bring that asset to its present location and condition, ready for its intended use. Think of it like this. If a cost is, necessary to get the asset ready to start earning money or providing benefits, it's usually part of that initial value. It goes way beyond the basic purchase price. So what kind of things are we talking about? Well, obviously the purchase price itself, but, with adjustments, like you'd take off any trade discounts or rebates you get, but you'd add things like import duties, non-refundable purchase taxes. Then there are all those costs directly linked to getting it working. Employee benefits, if your own staff built it, site preparation, initial delivery and handling fees, installation, assembly. And this is a key one, the costs of testing if the asset actually works properly before you start using it for real. Even professional fees, architects, lawyers, if they're directly related to buying or building it, they get added too. Oh, and here's one that's maybe less obvious. If the company knows it has an obligation, like a legal one, to dismantle the asset or restore the site later on, the initial estimate of those future costs can actually be included up front. Plus, under certain rules, borrowing costs, interest paid on loans taken out specifically for construction or acquisition can be added during that period.
Wow, okay. That is a lot more than just the price tag. So it really is about getting the asset to the point where it can actually start working for the company. All right, let's look at an example. Say Yukiko buys a new machine. They've got the list price. Then they pay import duty, delivery, installation, even some pre-production testing. And just make it interesting, they also bought a 5-year maintenance contract, got a trade discount, and a settlement discount because they paid early. Phew, what gets capitalized there?
Right. Okay. Good example. For Yukiko's machine, the capitalized cost would be the list price after you take off that trade discount. That's important. Then you add the import duty, the delivery fees, installation costs, and those pre-production testing costs. All of those are directly necessary to get that machine ready for its intended use. But here's the key difference. That 5-year maintenance contract, that's not capitalized initially.
Why not?
Because it's for future services, right? It's about keeping it running later, not getting it ready in the first place. It's an ongoing operational cost and expense, and the settlement discount for paying early. Generally, that's seen as more of a financing thing, like an incentive, not really a reduction of the asset's fundamental cost. So it doesn't usually reduce the initial PPE value either. It's an interesting little detail, that one.
Yeah, that distinction, getting it ready versus keeping it running, that seems really crucial. Okay, let's switch gears, something bigger, construction. What about, say, Hamco building a brand new store? They've got costs like land, architect fees, site prep, materials, direct labor, legal fees, and general overheads too. Plus, they took out this huge $25 million loan specifically for the construction. How does that all fit together?
Okay, for Hamco's store. The land costs, architect fees, site prep, materials, direct labor, and those legal fees directly related to the build, those would all be capitalized. Added to the PPE cost. They're absolutely essential, to get the store built and ready. General overheads, though, usually not, unless you can directly trace them to the construction project itself, which is often quite hard to do convincingly. So they're normally just expensed. Now, That $25 million loan, since it was specifically for this project, the borrowing costs, the interest paid during the construction period, yes, those would be added to the PPE cost. So let's say construction started April 1st, 20X1, and finished January 1st, 20X2. The interest incurred between those dates gets capitalized. It's worth noting, though, that you stop capitalizing those borrowing costs once the asset is substantially ready for its intended use. So on January 1st, 20X2, when the store was complete, even if they didn't actually open it for customers until, say, April 1st, 20X2, the capitalization stops when it's ready.
Right. Ready for use, not necessarily in use. Got it. Okay. So you've acquired the asset, capitalize all those initial costs. It's on the books. But what happens down the line if you spend more money on it? Like maybe a major upgrade versus just, routine maintenance. Does that always get added to the asset's value, or does it just hit the profit statement right away?
Yeah, that's about subsequent costs. And the rules here are actually quite strict. Generally speaking, most money is spent later, things like routine repairs, maintenance, oil changes for a truck, that kind of thing. It's usually about keeping the asset running as it is, maintaining its current state. Those costs are normally expensed straight to the profit or loss statement in the period you incur them. They don't increase the asset's value on the balance sheet. You can only add subsequent costs to the PPE's carrying amount if two conditions are met. First, it has to be probable that new future economic benefits beyond what the asset was already delivering will flow to the company because of this spending. And second, you need to be able to measure that cost reliably. Usually this means a proper upgrade, something that improves capacity, boosts efficiency, extends its useful life significantly,
That's a really key difference then. Probable future benefits beyond the current state. So let's go back to Yakuko's machine. If they later buy an $18,000 upgrade package for it, adds new components, and it reduces production time per unit by 15%, allows them to make more stuff without buying a whole new machine, would that be capitalized?
Yes, absolutely. That specific upgrade, it clearly meets the criteria. Why? Because it enhances the machine's ability to generate future economic benefits. It's not just fixing it, it's making it better, more efficient. Yakuko can now produce more, faster. That directly leads to probable future benefits, and the cost, $18,000, is clearly measurable. So yes, that's a classic example of an enhancement, an upgrade, that gets added to the asset's value. It's not just maintenance.
Okay, that makes sense. So we get the asset on the books, maybe upgraded, it's generating value, but, well, nothing lasts forever, does it? How do companies account for that sort of inevitable decline, the way assets wear out or become obsolete over time, that gradual consumption of value?
Right. And that brings us to depreciation. Depreciation is really just the systematic allocation of the asset's depreciable amount over its useful life. What's the depreciable amount? It's the initial cost minus any expected residual value, what you think you can sell it for at the very end. Think of it like applying the accrual principle of accounting. You're matching the cost of that long-term asset to the periods where it's actually providing benefits, generating revenue for the company, spreading the cost out, basically. And there are a couple of common ways to do this. The first one is the straight line method. Pretty much what it sounds like. You just spread the cost evenly over the asset's estimated useful life. Same amount of depreciation expense each year. Very straightforward. The other really common one is the diminishing balance method, sometimes called reducing balance. With this one, you apply a fixed percentage, but you apply it to the asset's carrying amount, its book value, after taking off previous depreciation. This means you get higher depreciation charges in the early years and smaller ones later on. It kind of front loads the expense.
Okay, so if you bought some plant for, say, $200,000 and you depreciate it at 25% using that diminishing balance method.
Yeah.
How does that actually look compared to straight line?
Well, with diminishing balance, that 25% isn't applied to the original $200,000 every year. In year one, yes, it's 25% of $200,000, which is $50,000. But in year two, the carrying amount is now $150,000, $200K, $50K. So the depreciation is 25% of $150,000, which is $37,500. And it keeps reducing like that. It reflects the idea that maybe some assets are more productive or lose more value faster when they're newer. Think about a new car, how much value it loses right at the start.
Oh, okay. I see. That makes sense for certain types of assets, definitely. But look, these things, useful life, residual value, they're estimates, right?
Mm-hmm.
Maybe it's sometimes years in advance. What happens if a company realizes, hang on, our estimate was wrong. Maybe the asset will last longer or shorter or be worth more or less at the end?
That's a really important practical point. And yes, they are just estimates. The accounting standards, IAS 16 specifically, actually require companies to review these estimates, the useful life and the residual value at the end of each reporting period, at least annually. And if things have changed significantly, if the estimates need revising, the change is accounted for prospectively.
Prospective, meaning
Meaning you apply the new estimate going forward over the asset's remaining useful life. You don't go back and change the depreciation you already recorded in previous years. It's about reflecting the new information from the point you realize it rather than constantly restating past results. It makes things more stable, I suppose.
okay, prospectively. So let's say a machine was bought for $120,000, original estimate.
Yeah.
10-year life, $20,000 residual value. But after 2 years, management reassesses. Now they think the residual value will only be $15,000 and the remaining useful life is only 5 more years, not 8. How does that change the calculation from year 3 onwards?
All right. So first, you'd figure out the depreciation for the first 2 years based on the original estimates. 100K, 20K, 20K 10 years equals $10,000 per year. So $20,000 accumulated depreciation. The carrying amount after 2 years is $20,000, $100,000. Now, at the date of reassessment, you take that current carrying amount, $100,000. You subtract the new estimated residual value of $15,000. That gives you a remaining depreciable amount of $85,000. And you spread that $85,000 over the new remaining useful life of 5 years. So the depreciation expense from year 3 onwards would be $85,000 at least $17,000 per year. It's higher now, reflecting the shorter remaining life and lower residual value, but only from that point forward. And here's something else that's, well, quite interesting about depreciation, especially for big assets like buildings or maybe aircraft. Often, these large assets are actually made up of several significant distinct parts. Think about a building. You've got the main structure, the roof, maybe the elevators, the heating system. When this is the case, the standard requires you to depreciate each significant part separately over its own individual useful life. You don't just lump the whole thing together.
Really? Depreciate the elevator separately from the main building structure. That's surprising. So if a company buys a property for, say, $100 million, and they figure, okay, the land is maybe $20, the building structure is 45 meters, the fixture's 24 meters, elevator's $11, and they all have different estimated lives. How does that work in practice?
Exactly like that. First off, land generally isn't depreciated at all, right? Because it usually has an indefinite life, it doesn't wear out in the same way.
Right.
But for the other parts, the building structure, the fixtures, the elevators, you'd allocate that cost, just like you said, 45 mils for the building, 24 meters for fixtures, $11 for elevators. Then you depreciate each one based on its own useful life. Maybe the building structure lasts 50 years, the fixtures only 10 years, the elevators perhaps 20 years. So you calculate the annual depreciation for each component, 45 meters, 50 years, 24 meters, 10 years, 11 meters, 20 years. Then you just add up those individual depreciation amounts to get the total annual depreciation charge for the entire property. It gives a much more accurate picture of how the asset's economic benefits are being consumed over time.
Okay, wow. Component depreciation. That's definitely a level deeper. So we've covered initial cost, subsequent cost, depreciation. But what if the market moves? What if an asset's actual market value changes dramatically? Say a building you own suddenly becomes worth way more or maybe way less than what's sitting on your books based on its original cost and depreciation. Do you just ignore that?
Now you're getting into revaluations. And this is where companies have a pretty significant choice under IAS 16. There are basically 2 models allowed for measuring PPE after initial recognition. There's the cost model. This is, well, simple. You carry the asset at its original cost, minus all the accumulated depreciation, and minus any impairment losses, which is a whole other topic, maybe for another day, straightforward. Or companies can choose the revaluation model. This allows you to carry an asset at its fair value at the date of the revaluation, minus any subsequent depreciation. This model aims to reflect the current market value of the asset on the balance sheet, which can be, more relevant information for users of financial statements. Now, if a company does choose the revaluation model, there are some really important rules they have to follow. First, it has to be applied to all assets in the entire class of assets. What does that mean? Well, if you decide to revalue one office building, you generally have to revalue all your office buildings. You can't just pick and choose the ones that have gone up in value.
Okay. Consistency across the class.
Exactly. And second, revaluations need to be done regularly enough with sufficient regularity, as the standard puts it, so that the carrying amount on the books doesn't differ materially from its fair value. It needs to be kept reasonably up to date. Finding the gain or loss is simple math, just the difference between the asset's carrying amount before revaluation and its new fair value. Okay, let's talk about what happens when the value goes up or revaluation increase. Generally, when an asset's carrying amount increases due to revaluation, that gain doesn't usually go straight into the main profit or loss statement. Instead, it's recognized in something called other comprehensive income, or OCI. Think of OCI as a sort of secondary statement showing certain gains and losses that bypass the main income statement but still affect the company's overall equity. This gain accumulates in equity in a separate reserve called the revaluation surpluses. However, there's a catch. If that increase is reversing a previous revaluation decrease, a loss, on the same asset that was previously charged to profit or loss, then that part of the gain does go back into profit or loss first, basically to cancel out the earlier hit.
Okay, so mostly to OCI, unless it's reversing a prior loss. Let's take an example. A building bought for $100,000, 40-year life. 2 years later, it's depreciated a bit, and then it's revalued up to $120,000. How does that gain flow through the accounts?
Right. So first, calculate the carrying amount after 2 years. Straight line depreciation. $100, 40 years. 2 years equals $5,000. So carrying amount is 100 come K, 5K equals $95,000. The new fair value is $120,000. So the difference, the revaluation increase, is $120,000, $95,000 equals $25,000. Now the accounting entries, you'd essentially wipe out the accumulated depreciation, $5,000. You'd increase the asset's gross amount on the balance sheet to the revalued amount, $120,000, and that $25,000 gain. Assuming no prior losses to reverse, that goes as a credit to the revaluation's surplus account, which sits within OCI and equity. It signals the value increased without boosting current profit. Now, what about the other way around? A revaluation loss, where the value goes down. The general rule here is that a revaluation decrease, a loss, is charged directly to profit or loss. It hits the bottom line immediately. However, similar sort of exception as before, if there's an existing credit balance in the revaluation surplus for that specific asset from a previous upward revaluation, then the loss is first debited against that surplus in OCI using up that previous gain. Only any loss beyond the amount sitting in that specific asset's revaluation surplus gets charged to profit or loss.
Yeah.
It's like that surplus acts as a buffer, but only for that particular asset.
Okay, so it uses up the buffer first. Let's try an example for that too. Say a property has a carrying amount of $108,000. Maybe its original cost was $125,000, accumulated depreciation $17,000. It gets revalued down to $95,000, but also happens to have a $10,000 balance sitting in the revaluation surplus from a previous increase for this specific property. How is that loss absorbed?
Good one. Okay, the carrying amount is $108,000. The new fair value is $95,000. So the total revaluation decrease, the loss, is $108,000, $95,000, $13,000. Now, you look at the revaluation surplus for this asset, you said it has a $10,000 credit balance. So the first $10,000 of that $13,000 loss is debited against the revaluation surplus in OCI, reducing that surplus balance to zero. The remaining $3,000 of the loss, $13,000 total loss, $10,000 absorbed by surplus, is then charged directly to the profit or loss statement for the period. Accounting-wise, you'd also eliminate the accumulated depreciation, $17,000, and adjust the asset's gross amount down to the new fair value, $95,000. It shows how that prior gain cushioned the immediate profit impact, but only up to a point. And a really crucial point here. After an asset is revalued, whether up or down, it must continue to be depreciated. You don't stop depreciating it. But the key is the depreciation charge going forward is based on the new revalued amount spread over the asset's remaining useful life. So if you revalue upwards, your future depreciation expense will likely be higher.
Ah, okay. Higher value, higher depreciation charge. Which I guess brings up another question. If an asset is revalued upwards, the gain mainly goes to OCI, not profit. But then the depreciation charge increases, which does reduce profit. Does that sort of link up anywhere? Does it affect anything else, like the company's retained earnings over time?
That's a fantastic question. And yes, it connects in a subtle way. You're right, the higher depreciation reduces reported profit compared to what it would have been if the asset stayed at historical cost. Now, the accounting standards permit it's optional, not required something called a reserves transfer. A company can choose, as a matter of accounting policy, to make an annual transfer from the revaluation surplus directly to retained earnings. How much? An amount equal to the excess depreciation for the year.
Excess depreciation.
Yeah, it's the difference between the actual depreciation charged, based on the revalued amount, and the depreciation that would have been charged if the asset was still measured at its original historical cost. So each year, the company can optionally move that difference from the revaluation surplus in OCI over to retained earnings. It's like gradually realizing that revaluation gain through reduced impact on distributable profits over the asset's remaining life. But again, only if the company explicitly chooses to do this as their policy. If they do, you'd see this transfer happening within the statement of changes in equity.
Okay, that's a really deep layer of accounting nuance there. The optional reserves transfer. So it seems like not just if you revalue, but when you do it during the year, could actually matter quite a bit for the numbers in that specific year. You mentioned sufficient regularity, but does the exact timing within the year change the accounting treatment?
Oh, absolutely. The precise date a revaluation happens within a reporting period can significantly change the accounting, especially for that year's depreciation charge. It's a critical practical point, especially in exams, but also in real life. There are basically three scenarios. One, revaluation right at the start of the financial year. If that happens, the revaluation is accounted for immediately, and the whole year's depreciation is calculated based on the new revalued amount. Two, revaluation right at the end of the financial year. Here, you'd first calculate and record the full 12 months of depreciation based on the carrying amount before revaluation. Then you perform the revaluation on that year-end carrying amount. So the revaluation itself doesn't impact that year's depreciation charge. Three, revaluation midway through the year. This is the most complex. You'd calculate depreciation for the part of the year before the revaluation based on the old carrying amount. Then you revalue the asset at that mid-year point. And then for the rest of the year, after the revaluation, you calculate depreciation based on the new revalued amount over its remaining life. So you end up with a sort of blended depreciation charge for that year.
So the timing really matters for that year's profit figure. Let's take a quick example. Building bought April 1st, 20X1. Financial year ends March 31. It's revalued at the year end, March 31, 20X6.
All right, revalued at year end. In this case, for the year ending March 31, 20X6, the company would first calculate and record the full 12 months of depreciation based on the building's carrying amount before any revaluation adjustment, let's say based on its original cost and life. Only after that depreciation is recorded would the revaluation gain or loss be calculated and put through OCI or profit or loss, adjusting the carrying amount right at the year-end date.
Right. And what if, say, an office building is revalued on October 1st, 20X1? That's exactly halfway through the financial year ending March 31st, 20X2.
Mid-year revaluation. Okay. For the year ending March 31st, 20X2, you'd have a two-part depreciation calculation. First, for the 6 months from April 1st, September 30, 20X1, you'd calculate depreciation based on the carrying amount before the revaluation. Then, on October 1st, 20X1, you do the revaluation, adjusting the asset's carrying amount up or down. Then, for the second 6 months, from October 1st, 20X1 to March 31st, 20X2, you calculate depreciation based on the new revalued amount spread over its remaining useful life at that point. The total depreciation expense for the year would be the sum of those two 6-month amounts. Definitely more calculation involved.
Definitely. Okay, so that covers the life and potential revaluation. What about the very end? When an asset's life is truly over or the company just decides to sell it, how do they get it off their books and what's the financial result of that?
Right, the end of the line. That's called derecognition. An item of PPE should be derecognized, removed from the balance sheet when it's disposed of, sold, scrapped, exchanged, or when the company expects no more future economic benefits from using it or disposing of it. It's done its job. When this happens, you calculate a gain or loss on disposal. It's actually pretty straightforward. You compare the proceeds you receive from the disposal or the cash or other assets you get with the asset's carrying amount, its book value, at the exact time you dispose of it. If the proceeds are higher than the carrying amount, you've got a gain. If they're lower, you've got a loss. And that gain or loss goes directly into the profit or loss statement for that period.
Simple enough. Proceeds versus book value. So if an asset originally cost $16,000, it has accumulated depreciation of $8,000, and they sell it off for $5,000 cash.
Okay, let's work that through. Original cost $16,000. Accumulated depreciation $8,000. So its carrying amount, its book value is $16,000, $8,000 equals $8,000. The disposal proceeds are $5,000 cash. Since the proceeds, $5,000, are less than the carrying amount, $8,000, there's a loss on disposal. The loss is $8,000. $5,000 is $3,000. And that $3,000 loss would be recognized immediately in the profit or loss statement. And just one final little twist on disposal linking back to revaluations. If an asset that was previously revalued upwards is disposed of, any remaining balance sitting in the revaluation surplus in equity that relates specifically to that asset, that balance should be transferred directly to retained earnings when the asset is disposed of. You can't leave it sitting in the revaluation surplus forever once the asset it relates to is gone. It's like a final cleanup entry for that asset's revaluation history, moving that unrealized gain into realized equity.
Okay, that makes sense. A final tidy up. It's a few. What does this all really mean then? We've gone on quite a journey here. From the moment an asset is bought, through its working life, potential ups and downs in value, and finally, its exit off the company's books.
Exactly. And I think the key takeaway is that accounting for PPE for these big tangible assets is so much more than just, tracking expenses. It's really about understanding how a company recognizes, manages, values, and ultimately reflects the contribution of its most fundamental investments. It involves a lot of careful judgment, those estimates of useful life, deciding whether spending is a repair or an upgrade, choosing the cost or revaluation model. And it requires sticking closely to these specific rules in IAS 16. And all these choices, they reflect strategic decisions, they reflect shifts in the market, they reflect operational realities. A company choosing to capitalize heavily might signal a focus on long-term growth, for example. And understanding these nuances, it isn't just for accountants, really. It gives you, as someone looking at the financials, a much deeper window into a company's financial health, its strategic direction, maybe even its operational efficiency. It just reminds us that every physical asset you see, every building, every machine, every vehicle, has this kind of hidden financial story unfolding on the company's books, a story waiting for you to uncover it. So maybe the next time you walk past a construction site, or see a delivery truck, or even just use the office printer, take a second to consider the complex financial journey that asset is on. It's quite something when you think about it.